Hello everyone, my name is Lee, and today I'm going to talk to you how we use the fundamental analysis in our trading. So when we talk about trading, right, people will think about lose money, and a lot of people will talk to you that they, even in the TV series, we will see that a lot of people lost money before in the trading, in the financial market, on trading or investment, right? This is true. Actually, it's 90% of the traders are not getting a consistent profit from the financial market that they initially wanted to. So this is a statistic why most traders lose money. Okay, there's a statistic here. Most of the traders, okay, start with the dreams to get rich quickly because trading is in a short-term period for a transaction, right? So they have frequent transactions in and out. So people think that trading can get rich quickly, right? So because of this wrong mindset or wrong perception, so 80% of the traders quit after 2 years, and 7% remain after 5 years, and in the end, only 1% can profit consistently from the trading. Trading is actually a marathon. It's not a short distance race. Okay, we can't go fast, but actually we can go really consistent pace and to reach our trading goals, which is consistent profits. And today I want to talk to you, I want to introduce you these 4 pillars of trading. In order to have a trading strategy that gains the generated consistent profit for you, okay, actually we have to have these 4 pillars and also 1 important foundation. So first, what is the foundation? Psychology and mentality trading foundation. As we know, right, if you have experience in trading, you will feel that when you see your hard-earned money involved, psychological affected. So it is a thing that we have to always train ourselves along the trading journey. That's why I put it as a foundation. So in order for us to have a trading strategy that generates consistent profit, we have to have these 4 pillars as well. So the first one is fundamental analysis. The second one is sentiment analysis, technical analysis, and the last one is risk management. We have to have these 4 under our trading strategy. We can't ignore anyone, okay? So, and today, what I'm talking about is fundamental analysis, which I think is quite important for us to know, but a lot of people actually undervalue this fundamental analysis. This actually helped me and also help a lot of traders to know that the overall direction of the currency. So let's see. Fundamental analysis can evaluating and measuring the intrinsic value of the currency by examining the related economic, financial, and other quantitative and quantitative factors. This is what fundamental analysis is. So in the trading, right, we open the trades, okay? We open the trades. So what we have to do? Okay, we have to decide 2 things. The first one is direction, buy or sell, right? If you think the currency will goes up, then you will buy. If you think the currency will be depreciated, then you will sell, right? So this is the first thing we have to know, the direction. And the second thing, many of you actually heard of people say, I got in too early. I got out too early. Something like that. So this shows what? This shows timing. Okay. After you know about the direction, right? What is the timing? Now or later? Okay. Are we going to enter now, or are we going to enter after certain market conditions have established? Also, what are the fundamentals shows? The fundamentals shows direction. Okay, to show the direction that we have to buy or sell. So the rules of fundamentals provides a better understanding of the currency, know what is the underlying forces that drive the currency, and empowers the trader to have the proper expectation of the market and direction of the currencies. We have to know about central banks, what central banks do and why they do it, how and when the central banks make their decisions, or what happens when they implement these decisions. We have to know about central banks. But we talk about central banks, right? It's not that in Malaysia is bank of Malaysia. It's not. Actually, we have to look at the major currencies or the major central banks, which is these 8 major central banks. The Federal Reserve in US, the Bank of Japan, Bank of England, UK, ECB, European Central Banks in Europe, Swiss National Bank, Switzerland, Reserve Bank of New Zealand, and New Zealand, Reserve Bank of Australia, and also Bank of Canada, you'll see. So this is the 8 major central banks we have to look at. So the first thing we have to look at, what is the goals of the central banks? Okay, what are their mandates? Every central bank has slightly different mandate, but overall they have these three goals. The first one, low unemployment rate. Their goal is have 100% full employment. Okay, about 4% unemployment rate is still acceptable. So this is what the goals of the central bank. And the next one, price stability. The goal is aim to achieve stability in prices, stable and low inflation rate. Okay, can't be too high and can't be too low. In an economy, right, we have to have inflation rate in order for developing the economy. This is what we can't actually avoid. But it can't still be too high, because when it is a high inflation rate, people will suffer from this price hiking, right? They will feel that the purchasing power they have now is already dropped. And the last one, stable financial market. Minimize the volatility of the financial markets when trying to achieving the first two goals, which is the low unemployment rate and also the stable inflation rate. So they have to change the policy bit by bit. It's not a sudden change, a sudden big change of the policy. So in order to achieve these three goals, we have to know that what central banks use. What tools are central banks use for achieving these goals? Okay, the first one, interest rate. Okay, second, monetary policy, and also that's one, language. The first one, interest rate. So why the central banks increase interest rate, why they cut the interest rate, and what is their consequences? So let's look at it. So the first one, interest rate hike. So when the interest rate increase, that means that have a higher cost of borrowing. Let us look at the saving perspective. Okay, they prefer savings now. Why? Because the interest rate in savings is also increased. So the savings now is more attractive than the borrowing. So people will tend to save the money, will tend to not spend the money. Okay, so central banks want to increase interest rate, because when inflation is too high, when economic growth is too good, okay, it goes too well. So the central banks have to do something, okay, have to do something to slow down the economic growth, which is this. They use this interest rate, increase the interest rate to slow down the spending, okay? So the inflation rate will also lower. Then why they cut interest rate? When the people don't want to spend, or I would say recession, or the growth, economic growth is too slow, okay, the central banks want to do something, what they call is encourage spending. So they cut the interest rate. When they cut the interest rate, right, they have the lower cost of borrowing, which people prefer spending than saving now. When you want to buy a house, you want to buy a car, or a business want to expand, so they use this chance to what? Borrow from the bank, because now having a lower cost of borrowing because of the cut interest rate. So what is the consequences of this? Is the boost economy, because the spending will already increase, right? But how the interest rate affect currency? We are the currency traders, right? We have to know the relationship between the interest rate and also the currency. So when increase the interest rate, right? Actually, we think about like this. So today I have two banks. The first bank give you 5% interest rate. Second bank give you 4% interest rate. Now you want to save money, okay? You want to save money. Which bank you want to choose, the A or B? Of course A, right? Because 5% interest rate is higher than B, 4% interest rate. So when the increased interest rate of the countries of the currency, people will tend to save the currency tend to save the capital in that currency. When they save in the currency, right, they have a high return rate, right? So when the country increase the interest rate, the currency tend to appreciate. And the other way around, the cut the interest rate, then they tend to depreciate, because foreign investors want to invest in the higher interest rate currency. Let's do some case studies. Bank of England cuts rates in emergency move to combat the coronavirus impact. This is the recent news in March. When it cuts rates, the price will tend to go down. Okay. So the second one, monetary policy. Monetary policy have two. The first one is restrictive monetary policy. they are used to reduce the money supply in the market. And also the expansionary monetary policy, to increase the money supply in the market. When it's restrictive monetary policy, which is reduce the money supply, people will tend to save or they tend to not spending. Okay, then they can slower down economic growth. But in the expansionary monetary policy, including QE, quantitative easing, or including printing money, are all expansionary monetary policy. It are used to increase the money supply, which is encourage spending and boost economy. Language. So what is language? Okay, central banks are also like a business. They have a president as well. So when this kind of people, this important roles, this important person come out and give a speech, traders usually want to listen and try to get some hint, try to get some direction, the next direction of the central banks, what they want to do, what they have to implement the monetary policy in the futures. And from that, we can know about the direction of currency as well. In this term, in financial terms, we have two terms talk about language, which is hawkish and dovish. So for hawkish, right, it's a symbol of control and dominance, which means that central banks maybe will raise interest rate, which is prevent excessive inflation, strengthen the currency, and also higher savings interest rate. People tend to save than spend. For dovish, right, is a symbol of peace and freedom, which is maybe the central banks will lower the interest rate, okay, lower cost of borrowings, encourage spending, and will boost economy, okay. So this may be because economy is slow down, okay, or recession happening. So the central banks have to use this dovish tone. And also the other thing that have to be known about is this economic indicators. It is economic data release. Central bank use this economic indicator to make the policy decisions. That is why, as traders, we have to also look at these economic indicators. What economic indicators include? Include employment data, which is measures employment rate, like non-farm payroll, like unemployment rate, okay, etc. Other than this, they also have this price data, so it measures growth and inflation. Okay, include GDP, include CPI, and also retail sales. Okay, is measure. Okay, so for GDP is measure the total value of the country's economic activity within a given period, the total value. And CPI is measure the consumer spending. The retail sales measure the retail sales to contractors and other consumers. So this is what the economic indicators means. You can always go to look at these economic calendars. Okay, what I use usually is the forexfactory.com. You can look at the economic calendars and you can know the meaning or why the result they can actually affect the currency. What I want to cover today is how can we use these economic indicators to predict or to forecast the direction of the currency. Economic indicators is actually academic transcript. Okay, academic transcript of the countries. So we know that from the economic indicator from like GDP, we know that it's doing good or bad, okay, something like this. So GDP, so today what I'm going to look at is GDP, okay, the gross domestic product, employment rate, consumer confidence, consumer price index, purchasing managers index, and retail sales index. This is what we have to look at it to forecast or to determine the direction of this, the countries. So for example, today we'll do a case study about these two countries, which is Australia and also the United States. So the first one, GDP growth rate. Let us look at it. We look at 2019, okay? We know that overall the Australia is weak, okay? It's weaker than the United States, right? But recently you see that the growth rate is going up, which the US, okay, start to weaken. So this is what we can observe here. So next, CPI, Consumer Price Index. 2019 2020, actually the Australia weak and United States strong, but recently Australia become strong and US weaken. Okay, next, consumer confidence. Consumer confidence, Okay, it's overall neutral, and the latest one, Australia is 75.6 and US is 71, is slightly better than US. Okay, next, the unemployment rate. Unemployment rate is the higher the worse. Okay, this is not the better. So let's just look at it. So here, okay, overall is Australia is weakened and US is strong. That we know that last week, okay, the unemployment rate come out and this is really spiked out. It's like 14 point something % of the unemployment rate in US. But 14th of May, okay, Australia will come out also the unemployment rate. So we have to look at it to determine the direction, determine the performance of the countries. So lately, we say US is weakened in economy in the aspect of unemployment rate. Next, Purchasing Manager Index, PMI. PMI above 50 is usually the good indicators that shows the country is doing good. Okay, the economy is doing good, but below 50 means that the country is not doing really well. Okay, so we can see that in 2019, the Australia is doing not really good, but the US is strong, and lately actually is neutral. Okay? The recent result is US 36.1 and Australia 35.8. Both of the countries' economy, both of the countries' PMIs is under 50. Means that the economy is not doing well, both countries. And last one, retail sales. Okay, we look at this. Okay, the retail sales for Australia in 2019 is lower than the US, which is, I would say that, yeah, Australia is weak and United States strong. But layly, we can see it's very obvious. Okay, the United States retail sales drop a lot, but Australia increase. Okay, so when you compare with here, we know that US is doing weak. Okay, and Australia is strong. Last thing here, okay, interest rate is also very important for us because we know the interest rate tends to affect the currency, right? 2019, we know that the Australia is lower than US funds rate, okay, the interest rate. But lately, they are both same, which is 0.25%. So we will say that they comes to the same level of the interest rate now. So what we can have a conclusion here, in 2019, okay, Australia and United States, okay, we do some comparison in this table. So the GDP, okay, is Australia weak and US strong. CPI, Australia weak, US strong. Consumer confidence neutral, okay. Unemployment rate is also Australia weak, US strong. PMI weak, strong. Retail sales is the same. Interest rate is also the same. So we know that overall the AU, or I would say the Australia, is doing not really good if compared with the United States, right? So this is where we can forecast the direction of the Australia. So in the whole 2019, right, we compare both countries. We know that it's quite obvious that Australia is doing worse, or I would say United States is doing better than Australia. So we can predict, we can forecast the direction, which is sell. Aussie US dollar is just sales. And we look at the chart, right? We know that in 2019, it's pretty obvious that the overall direction of the Aussie dollar is now. It really matched to our fundamental analysis. Here, if you are the swing traders, we actually can enter trades here. We know the direction we have to sell, so we don't look at buy. Here, we'll sell, which here, we'll sell, which here, we'll sell, which here, we'll sell. And I'm pretty sure that you can make some money here. So that's how we look at this fundamental analysis to help us to know that the overall direction of the country, of the currency. So let us come to current. What is the 2020 performance of these two countries? It's actually a little bit opposite already. So look at it. The GDP growth rate, okay, for the Australia is strong, okay, the US is weaker. CPI, Australia weak, US strong. Consumer confidence, Australia strong and US weak. Unemployment rate, Australia strong or US getting weak, and because of last week. But we also have to look at unemployment rate released in this week for Aussie. And PMI actually is neutral. Retail sales is very obviously Aussie is strong and US is weak. And the interest rate, both of them come to 0.25%, which is, I would say, neutral. So what is the forecast of the direction of this Aussie dollar? So the COVID-19 outbreaks, okay, is start from China. So China economy dropped and the Aussie dollar was affected. We all know that the Aussie dollar and China's have the correlation, right? Because China is the biggest trade partner of the Australia, so they have a correlation there. So now the US economy is crashing, is it? China's economy is recovering, and Australia's economy indicators are showing better results than US, which we did just now. So what is the next direction do you think about the Aussie dollar? So this is the question I want to ask you today. What's next? Okay, when you look at the chart, right, we know that the price before here, the lowest since in March because of the outbreak from China's and Aussie is really affected that time. Yeah, they reached the lowest since 2008. But now you see that the price are recovering and it tends to break here. We have to really look at the economy indicators released in these few weeks. And we can know that, or we can forecast the direction of the Aussie dollar by just looking at this fundamental analysis. And then we have the direction bias already. We know that our Aussie dollar maybe we just look and buy. Okay, so this is what I do for fundamental analysis. So for myself, I use it as direction bias, and then I will look at technical analysis as well. So that's all from me. Thank you everyone for listening. I hope this slides, this analysis helps you. This videos helps you, and see you again next time.